this roadmap, and then we'll have time for questions. So I look forward to engaging in this, because I hope to be able to have a discussion on this, because a lot of the things that I'm going to be talking about in terms of the clear regulatory gaps in the Canadian crypto asset ecosystem, it's not entirely certain how we should proceed. There are various considerations. There are various regulatory approaches. I'm going to start by identifying what we've done so far. For those of you who are in this area on the regulatory side, you'll know that pursuant to 2 staff notices, CSA IROC staff notice 21327 and 21329, the Canadian Securities Administrators have taken a very novel approach to establishing the crypto asset regulatory perimeter in Canada. I'm going to identify and introduce that novel approach. I'm going to seek to justify it. I think it's a positive development in the crypto asset ecosystem. But I'm going to show where first uncertainties remain in the regulatory ecosystem for crypto assets, clear gaps emerge, and with respect to those gaps, I want to lead a discussion here on what are some of the challenges in these gaps, particularly in regulating DeFi, decentralized finance, and I will come to what that means and the uncertainties around that definition. And then finish by scanning some regulatory approaches that are starting to be discussed globally and here in Canada as well. So let's start with the novel and international idiosyncratic crypto asset regulatory perimeter in Canada. Now, crypto assets and entities transacting in crypto assets, virtual currency, we can use the term crypto asset as synonymous with a number of things. Now, there are nuanced differences, which we probably don't have time to get into, but I'll scan some of them here. By the way, I'm happy to send these slides to Mark when I'm done, okay? So happy to do that, and then he can send it out to the participants here. The earliest regulatory formation in Canada was with respect to anti-money laundering and terrorist finance rules. So you saw FinTrack move fairly quickly. You saw changes to the Proceeds of Crime, Money Laundering and Terrorism Financing Act and regulations in 2014, and then again in 2018 and 19 and 21. There's been a series of shifts around money services business, including what's been done provincially in Quebec as the only provincial jurisdiction to have money service licensing, a separate money service business licensing regime in Canada. You've seen a lot of movement around transacting in virtual currencies around anti-money laundering perimeters. So move that aside for a sec. That exists. I think that's been quite robust in that area. What I'm going to focus on is not on that. I'm going to focus on the securities regulator perimeter. So there's been this lingering question. You see it, and it's been, for the most part, resolved in Canada, with the exception of DeFi, which I'll come to. But who regulates Bitcoin? Who regulates crypto assets? You know, in Canada that we had a catastrophic platform failure, Quadriga. It's been highly identified in the media. For those of you not familiar with it, it was the case of almost $200 million of crypto assets and fiat went lost when the proprietor of the platform, Gerald Cotton, died, and he was the only person in control of the private keys. That happened in 2018, and that precipitated then a series of consultations that emerged that has resulted in the top left-hand corner of this sphere. Well, let's just go through this for a second to kind of identify the regulatory perimeter, starting with the question of, are crypto asset securities? Well, that depends on how we define crypto assets. So in the red, digitized securities, so tokenized securities that trade on a blockchain, these are clearly securities. Now we have applications of these in this country. We have CSA sandbox relief that's been given to FinHaven in BC, to Token Funder, Token GX. So we see, so this is where traditional securities are distributed by an issuer, but they're done on a blockchain. Well, we know that that is within securities perimeter because the digital securities are securities. They're inherently securities. What gets more complicated as we move around the sphere here. So in 2017 and 2018, after the hack of the DAO in the United States and the pronouncement by the SEC, there was a large amount of regulatory attention given to ICOs, initial coin offerings. Here's where some crypto asset is distributed to the public, and the crypto asset has certain properties that might look like a security. Perhaps there's a profit participation, perhaps there's some type of voting rights to that. The securities regulators put out 2 staff notices successively around ICO, one around ICOs and one around utility tokens, ICOs in 46307 and utility tokens in 46308, saying many of these look like securities, at least when they're distributed initially in the capital raise on the basis of investment contract analysis. Now, there's gaps. No one's ever said if Ether is a security, even though Ether performs an obvious, on the Ethereum network, performs an obvious utility function. There's been, discussions by leading regulators in the US, like Bill Hinman, who said it might have been a security at one point, but maybe we've got to the point of decentralization on Ether. We know that Ripple, for example, XRP, is in protracted litigation with the SEC, and our Canadian regulators are kind of watching that, saying, well, is that the SEC is making an allegation that this was a security when it was distributed and remains so today under investment contract analysis? Oops. There's lingering questions in this area, but it appears that if you distribute something to the public in the context of a capital raise, you raise money, you issue some type of a coin that has a utility function, there's a strong possibility that that could be a security. Now, where the uncertainty lies, which I'll get into more, is these things called governance tokens that exist in the DeFi space. Okay, well, let's just keep moving along here. What about asset tokens? Okay, what about something that is a digitized representation of an ownership interest in an underlying asset like real estate, art, or some other collectible, or the increasingly popular non-fungible token space? I'm going to come to this one in a second here. I want to zero in though on the gray, because this is the novel approach that Canadian regulators have taken. Canadian securities regulators, for those of you who don't know, Canadian securities regulators are regulating the trading of Bitcoin. Bitcoin's not a security though. Bitcoin is a commodity. It's not a security on its own. There's no central issuer. There's no centralized control. There might be a possibility for a 51% attack, but that's a different consideration. There's not a single regulator in the world or a single academic in a paper that I've ever seen. Well, actually, I saw one that said the possibility for a 51% attack lends itself to a potential application of securities laws, Bitcoin inherently. But generally speaking, no one in the world thinks Bitcoin is a security on its own. But it's regulated by, but the trading of Bitcoin is actually regulated now by Canadian securities regulators. How? What the Canadian securities regulators have said is that the way that it's traded on a crypto asset trading platform creates either a security or a derivative. They call it a crypto contract in CSA staff notice 21329, a crypto contract between the platform and the user of the platform. The platform's providing some type of custodial function. They provide a contractual delayed delivery right to the user of the platform, and this custody-based delayed delivery creates a security, like an investment contract, or a derivative. Interestingly, they don't say which one it is. This idea first came out in a consultation paper in early 2019, 21402, where they put it out into kind of the informational ecosystem. Received a lot of comments letters. I was actually working as a senior policy advisor at the commission at this time before I joined the faculty at the University of Calgary. And the there was a variety of comments given on whether or not a crypto asset trading platform, so like CoinSquare, okay, if it trades Bitcoin, should it be subject to securities regulation when Bitcoin isn't a security? There was strong support actually for this jurisdictional approach. There was some comment letters, mostly from the blockchain space, or there was a comment letter received by Kraken, the mega crypto asset trading platform in the US, saying, no, it's not a security, it doesn't create a security, it's ultra vires jurisdiction. In any event, the securities regulators moved forward. They moved forward in early 2020 with CSA Staff Notice 21327, establishing this jurisdictional assertion, saying if a platform custodies Bitcoin or any decentralized crypto asset, and they provide the right to have, when I say custody, I mean like an internal wallet. You log into your platform and you can see your balance on this platform, but you don't have the keys. Your Bitcoin is being held by that platform. If you don't have custody, if you don't have the keys, not your coins, not your keys, not your coins. CSA said, if an entity is providing a custodial function for you, and you have the right for them to give you your Bitcoin, that relationship creates a security or derivative. They followed up earlier this year with CSA Staff Notice 21329, which says, well, what are the implications of that? And as for those of you in the space know, that the implications of this are that crypto asset trading platforms are being regulated in ways akin to either what an investment dealer is regulated as, a marketplace, a lot of them look like ATSs, not traditional exchanges, or some type of a hybrid of those things. And so each one of these crypto asset trading platforms is having to be registered right now, either as a restricted dealer or a full investment dealer, which requires IROC membership. I stress that this is internationally idiosyncratic. There aren't other regimes, or there aren't other regulatory frameworks that are taking this approach. And I've had discussions with the SEC on this and presented on this, and we have a novel approach. I don't think that our novel approach is bad. In the paper that was linked in the invitation to this, I argue that, frankly, it's consistent with where the risk is. I think it's consistent with what we've done in terms of anti-money laundering, know your client measures, and enacted by FinTrack, and what's happened in the US with FinCEN. 99, there's studies showing empirically that 99% of 2020 global cryptocurrency and privacy coin trading volume happened on centralized exchanges. So this is like a point of most risk. And their historic point of vulnerability: hacks, pricing, fraud, price and trading volume manipulation, operational failure and fraud. And it's consistent with the legacy approach to financial markets at large, which is entity focused. I believe that it is the framework that they've outlaid in, or that the CSA has outlined in 21329 is flexible. It allows for exemptive relief. I believe it's a positive development. I think it'll stabilize the market. It may decrease the number of operating venues, because I think there's something like 70 or so crypto asset trading platforms in this country, and they all have to go in to obtain some type of regulatory status. And we've seen some platforms pull out of Canada, and we've seen the Ontario Securities Commission engage in some enforcement measures against Poloniex, Qcoin. I think we'll see some consolidation in the market, but I also think we'll see some trust in the market too. And this is a good time as retail and institutional investor interest continues to be heightened. As we see all these exchange traded products holding Bitcoin and Ethereum and other types of crypto assets, people are becoming interested in direct ownership of Bitcoin. And I think it's a positive dynamic to have a regulatory framework for this. Okay. But what 21327 and 21329 didn't answer is some evolutions in the market. And as I will show in a minute here, there are some clear gaps that are completely unregulated in crypto assets. So which begs the question of, well, what do we do about that, if anything, in terms of regulators? Well, let me first start with some uncertainties. The large crypto asset trading platforms in the US and internationally, so like Kraken, Gemini, Coinbase, Binance, FTX, they are starting to intermediate services. They're starting to intermediate yield farming, which is supplying crypto inventory to smart contract-based automated market makers and on DeFi protocols, and this generates interest. There's no regulatory determination or statement at all on what this means. Is this a new security? Can these platforms do this if they want to do it in Canada? Similarly, platforms internationally and in the US are beginning to intermediate staking. It's where a client can stake, they can in a way lend their crypto assets and have them used to validate transactions on a proof of stake blockchain network, which is equivalent in different, but think conceptually of mining in a proof of work network. Is this a new crypto contract? Is this a delegated software as a service? We don't really know. Is a new security being issued when a reward is generated from a staking network? You know, similar to the yield farming. So these are areas right now that don't have any regulated parameters around them. The gaps in 21327 were that a huge gap, which opens up the DeFi portal here, is that if you take custody of yourself, of your crypto assets, so if I download a wallet that I can control, and someone sends me Bitcoin directly to my wallet, that someone who sent me Bitcoin, they don't have to register as a dealer or a marketplace, as long as I control the keys and there's no the specific parameters are set out in 21327. But by implication, we don't have any standards right now on those wallets themselves. We don't have any technology standards. These wallets are unregulated completely. As I mentioned, we have this ongoing question about governance tokens that are distributed, and I'll explain those in a second. Another question that is unanswered is NFTs. So non-fungible tokens, which are a digital representation of ownership, and it could be to a lot of things. It could be a digital image, for example. And so you're something like the Beeple art that sold for $69 million, not million. Some type of blockchain-based proof of ownership of some other asset. A question has emerged as to whether or not these are securities, because NFTs and the trading of NFTs are not regulated at all. They're completely unregulated. Now, they might be if you're exchanging fiat onto an NFT marketplace. Anytime there's an exchange of fiat for any form of digital currency, you're going to get caught by the FinTrack rules and the Quebec money service business rules. So there is that that prima facie initial potential for money service business. But if you acquire Ethereum on a DeFi ecosystem and move Ether onto some type of an NFT platform or NFT trading marketplace, NFT trading marketplaces aren't regulated at all. And so, as I mentioned in my paper, this is an interesting area of analysis. Could an NFT be a security? You might think about NFT and think, well, what is that? It's like digital art or some type of meme or LeBron James dunking or something like that we digitize and link ownership to on a blockchain. Well, that doesn't seem like a security. That doesn't seem like a business that's operating. But there's been some emerging scholarship in this area that says it might be, if on a threshold question, a platform actually facilitates and curates the organization, marketing, distribution of the NFT, including making offering and timing decisions which can affect both the demand and the value of the NFT. If the proprietor and operator of the NFT marketplace is specifically and tactically and strategically organizing, marketing, distributing these NFTs and making timing decisions, maybe there's an investment contract there. Now, there's rebuts against that from the jurisprudence, like the value potentially being derived from general economic factors. But then there's a secondary analysis on this question about what about the marketplace itself? Is it possible that if the marketplace is holding custody of my NFT, providing some type of custodial function, and all I have is a user account with a marketplace that I can log into. Is that the same thing as the crypto contract? Is that the same thing as how regulators are regulating Bitcoin right now in this country? These are questions which are uncertain. No regulator in Canada has actually opined on this yet. Another huge area of uncertainty right now is stablecoins. So Bitcoin, Ethereum, and the whole host of Bitcoin analogs, so any, Litecoin and Dogecoin and you name it, they're not really being used that much as payment mechanisms. There's lots of interest in them, but the interest seems to be in terms of asset value speculation and asset appreciation. So the potential that if I buy this thing, it's going to go up. I may not know what Dogecoin is. I may not even know how to explain it to my friends, but I have this feeling it might go up because Elon Musk keeps tweeting stuff, okay? But I'm not buying Dogecoin because I'm going to go use it to buy my groceries or pay my rent. And even you take some of these meme coins out and say, well, let's just go back to Bitcoin. How many people are actually paying the rent with Bitcoin? How many people are actually, paying off down debt with Bitcoin, paying on their mortgage with Bitcoin, buying their groceries with Bitcoin? Very, very few, very little. It's at least at the moment, and I know that there might be Bitcoin maximalists on the call who say, well, the volatility issue will subside, and you might be right. But at the moment, they're not being used as payment mechanisms. This has led to this emergence of these digital assets called stablecoins. Stablecoins are a digital asset that seek to maintain a stable value relative to another asset. The regulators in Canada have not opined or provided any regulatory clarity on this yet. I know they're working on it, and there's complexities to this because it's really highly contextual. There's not a universal definition of what a stablecoin even means. You have a whole bunch of different types. You have some like Tether, which purport to hold what we call off-chain collateral, meaning we're issuing these Tether coins, and for every dollar we issue, we're holding $1 of commercial paper or fiat somewhere in a bank somewhere, or with some type of a custodian. Well, they're not the only form of stablecoins. There's also crypto-backed stablecoins, so where collateral is held on-chain. So like the MakerDAO protocol with the DAI stablecoin. You also have algorithmic stablecoins, which I've actually published a piece just a couple weeks ago on some of the fragilities in these algorithmic stablecoins. And by the way, if you go to my name, ryanclements.com, you can see all my scholarship is there, including the piece that I'm talking about today. So the challenge of stablecoins is like, okay, first off, there's about a bunch of varieties, but what are these things? Who should regulate these? Are they securities? Some look like securities. Some resemble some of the asset-backed off-chain stablecoins resemble either money market mutual funds or ETFs, exchange traded funds. Others look like kind of like a deposit and they might fit in with an exemption on securities rules that moves them into the banking rules. Others kind of look like a derivative, to be honest with you. Some of the algorithmic ones look like investment contracts. So we're at a time right now where the regulators and academics are surveying the landscapes going, well, these things are being purchased, at least. They aren't regulated in terms of the issuer of the stablecoin having to file prospectus or being subject to banking type regulations. Now, the President's Working Group, an initiative of the U.S. Department of Treasury, just released last week a proposal stating that they think stablecoins should be regulated as depository institutions, insured depository institutions. So if you're an issuer of a stablecoin like Tether or like Facebook in its first its Libra iteration and now with Diem, you have to be regulated like a bank, which means prudential controls and capital controls and stress tests and orderly liquidation, and it's a very significant regulatory regime. There are concerns around the systemic implications of stablecoins that if people start actually using them like money, what happens if we, just like a bank run, what happens if everyone gives them back at the same time. Everyone goes back to the stablecoin issuer and says, give me my money back. I don't want to use it anymore. Do they have on reserve sufficient funds held to be able to give the collateral back? Or like banks, are they engaging in some type of fractional reserve lending? And if they are, then they should be subject to the same regulatory parameters as a bank is. And so this is an area that's live and it's not settled in Canada at all. Okay, so the clearest gaps are in the DeFi ecosystem. And the gaps give rise to a significant challenge for those of us who are financial regulatory scholars and interested in this space and interested in policy formation. You know that in financial markets, products, and services, the entire regulatory legacy framework looks to an identifiable intermediary. So the imposition of disclosure rules, registration, supervision, prudential measures, custodial standards, enforcement, all of it, we look to an identifiable intermediary or issuer. So whether it be the issuer of a security that is then subject to an initial prospectus disclosure and ongoing continuous disclosure and ongoing corporate governance rules, et cetera, or the intermediary that facilitate the sales of those, like investment dealers and marketplaces, and not just for securities, for banks. You know, you think about the financial ecosystem, we're looking to intermediaries. Well, DeFi, decentralized finance, are applications which operate without a traditional intermediary or even a custodial services. They're conducted through automated open source smart contracts or software protocols, which allow for peer-to-peer interaction on a decentralized, programmable blockchain, accessible by users with self-custody. Let's dig into that for a second here. So the World Economic Forum just put out a piece, which is a real informative piece. Kevin Werbach at Wharton was one of the co-authors on this, kind of trying to deconstruct DeFi a little bit and say, well, what is this stuff? There's over $100 billion of value in crypto assets in these DeFi applications. So what are these things? Well, effectively, the report describes them as financial services offered on a public blockchain. Okay, let's dig into that more. It has a goal to disintermediate legacy finance. What does that mean? Well, think about the financial system. Think about what a bank does. Bank takes deposit, performs a liquidity and a maturity mismatch, lends it out, fractional reserve. Banks do lots of different things, but think about an investment dealer. Think about how they facilitate capital raises. Think about an exchange. They perform a function. And there's a whole host of credit originators that function in the financial ecosystem. And think about dealers that facilitate derivatives and investment product issuers and asset managers and insurance companies. And so what DeFi tries to do is they say, we can actually do all of this with basically programmable software, or software programmed on blockchains that self-executes and is automated. So individuals can come to these software and they can transact peer-to-peer without having a bank or an exchange or a insurance company or a derivatives dealer or name the intermediary. We can peer-to-peer interact on a blockchain. And the idea came from Vitalik Buterin, a Canadian, who looked at Bitcoin early on in 2012, 2013. I think 2013 was when he first got the idea for Ethereum. We looked at Bitcoin and he said, Bitcoin's great, but it stops short. It solves the double spend problem for one thing, for the transfer of value on the internet. Okay, it creates this consensus mechanism, proof of work. We can trust that the transfer happened because of the way that the Bitcoin distributed network and the cryptography and the proof of work system works. Okay, that's great. But Vitalik says, what if we made it programmable? We could then, if Bitcoin is disintermediating how banks transfer money around, what else could we get rid of? We could get rid of exchanges. We could get rid of how banks lend. We can get rid of a whole host of functions. And this created the DeFi space. So you have some type of financial service or product. There's some type of transfer of value. It operates trust minimized through a consensus mechanism. We have a programmable, self-executing, automated, permissionless protocol operating on a public blockchain like Ethereum, and there's competing ones to it. It's non-custodial. We're not asking for an intermediary to hold our crypto assets. We hold our crypto assets ourselves. We interface into DeFi, and it's open, so it can be composable. It can be created. It can be copycatted. There's layers to these things. What's happened since that? There's been a lot of use cases for this. There are many. There's over 200 DeFi apps right now. There's well north of 100 billion in locked-in value on DeFi applications right now. What are some of the applications? There's lending protocols. So things like Aave and Compound, you can borrow off of DeFi. Now you have to collateralize it, and you have to over-collateralize it, which limits some of the retail usefulness of these types of things, but they exist. There's borrowing and lending. There's derivatives markets and prediction markets. There's exchanges. So we've moved all of our exchanges in Canada, like CoinSquare, into this regime from Staff Notice 21329, saying you have to be regulated as investment dealers and marketplaces now. Meanwhile, these DeFi exchanges like Uniswap and PancakeSwap, no one regulates those at all because they're software. But if I want to trade crypto, I can go to one of these decentralized exchanges, link into a smart contract, trade my crypto. And there's emerging investment advice in this area that none of it is getting caught. You don't have to go through the process of becoming a registered investment advisor, portfolio manager. All of this stuff is happening in a clear gap to the regulatory system. So, for example, these exchanges, these users with self-custody can trade on a decentralized exchange. These decentralized exchanges provide automated, what are called liquidity protocols. They're smart contracts. They're self-executing. There's market-making systems coded into programmable blockchains. And a way to think about this stuff, and again, I'm happy to send these slides out, is basically software that is self-executing, that operates on a blockchain, a public blockchain that creates a settlement function. You interface into that software, and everyone interfaces into it. If you want to trade, you interface into it. If you want to be a market maker and supply crypto to facilitate the trading, you interface into it. And so then the question then becomes, when the regulator looks at this, what are they regulating? Are they regulating the software? Are they regulating the blockchain that it operates on? Are they regulating the anonymous people across the globe that are interfacing into this? It creates some very significant challenges. There are lingering questions in this space about, is it truly decentralized? I'm going to come to that in a second here. I mentioned derivatives markets. So you have an emerging number of applications in DeFi that, if you think about a derivative like a call option or a futures contract or a forward contract, it's a bilateral contract between two parties. Now, normally we enter into these bilateral contracts either through some type of a dealer who facilitates it in the context of like a forward contract or an option, but most of the time through standardized options that trade on exchanges. And so the idea here is, why do we need the middleman? Why do we need the exchange? Why do we need the investment dealer? If it's a bilateral contract, can't I meet you somewhere on the web and we can engage in this contract together? The answer to that is, yeah, that's happening. We have things like Augur, which is an open source decentralized protocol for lottery pools and global no limit betting, and they have binary options which are actually banned in Canada pursuant to multilateral instrument outside of BC, multilateral instrument 91102. We have protocols like Synthetics, which allows you to create crypto assets that mimic the performance of other assets, just like options mimic the trading, and the price of options mimic the performance of their underlying. We see the synthetic asset creation on the Mirror protocol on the Terra network, which actually was just the subject of some SEC subpoenas. But again, it's this idea of public blockchain exists, they're programmable, and so they're programmed with an automated process to allow the software to perform a function that the intermediary otherwise did. They're growing. Total locked-in value has rose dramatically from 2020 to 2021 in particular. The largest public blockchain to perform DeFi functions is Ethereum blockchain, but there's competition. There's a wide variety of emerging blockchains that are programmable that say Ethereum stops short, and it's slow and it's costs a lot, and there are lots of ways that we can actually improve on Ethereum. And now the question then lends itself to, well, what is this stuff being used for? So if we say that there's in June 2021, there's $100 billion of locked-in value across the crypto asset ecosystem on all DeFi platforms, and 1.2 million user wallets and 200 DeFi applications, like, what is this stuff? Is this a friend of mine at the Securities Commission said, it's like an insano carnival that only people who feel comfortable go into. And it seems like the evidence right now is that might be somewhat true. What I'm interested in as a systemic risk researcher is, in what ways can the volatility and the leverage that's being built up in this system, because a lot of these applications, like lending applications and DeFi derivatives applications, they're being used to generate leverage for the purpose of betting on the movement of a crypto asset one direction or the other. What's interesting to me as, again, as a systemic risk researcher in financial markets is, when does grandma's money get in play here? Does it get into play? We're seeing, and I'll develop this next, like we're seeing much greater retail interest in crypto. So we're seeing a wide variety in Canada of exchange traded funds that have been approved. People who maybe can't even explain crypto are buying it for fear of missing out. We now are moving the centralized trading platforms into the regulated space, which creates trust and likely leads to more retail interest in it. Does that mean they're engaging in DeFi? Not necessarily. There are a lot of structural reasons to suggest that Main Street adoption in DeFi will be slow. For those of you who've spent time in DeFi, you know that the interfaces and the APIs aren't easy to use. They're, even for someone who's conversant in this world, you go in there and it's not as user-friendly as, say, like your bank's trading app is. The borrowing and lending, or the borrowing requires over-collateralization. So in some ways it acts as a closed capital or inefficient capital system. It's used to basically create leverage. Like, what do I mean by that? Well, if you wanted to speculate on the movement of a particular crypto asset, you could collateralize Ethereum on the Compound protocol. You could get a comp, and then you could trade it for a different crypto asset that you were speculating on the price movement on. If you're right on your bet, the movement goes up, then you can sell it. You can then release your Ethereum, and you've gained some value. You've created leverage. You've created margin through this system. As a result, though, because you have to collateralize to get your hands on that margin, it would seem to restrict it to the people who actually own some type of crypto asset that can serve as collateral. There's a lot of volatility and price instability, which makes mainstream adoption, at least in the moment, less likely. When I say mainstream adoption, I mean like people looking to DeFi to get their small business loan or their mortgage, rather than conventional banks. The instability of crypto in general would seem to make that less likely, at least in the short term. There's limited on-ramps from the legacy system into it. You know, people don't they don't trust the governance yet. There's a lot of lack of accountability, which leads to my final point about, well, how do we regulate it if we even do regulate this stuff? And what are the impetuses and drivers behind the regulation of it? And some of the particularly the Ethereum blockchain is pretty expensive. But as I say that, I scan the ecosystem, and in addition to the crypto decentralized exchanges and the lending protocols and the derivatives protocols, we're seeing new DeFi apps emerge. We're seeing new increased trading volume. We're seeing new forms of lending products like unsecured lending, for example, credit delegation, business borrowing, new options, credit default swaps. We're seeing DeFi-based insurance use cases that are emerging, asset management, like crypto indexes, synthetic tokens, structured products. Seeing these things called aggregators. So basically, a good example of this would be, for those of you who are interested, is the Terra network. It's a South Korean DeFi protocol that allows for a variety of different applications that are layered together and kind of interconnected with the stablecoin Luna. So you look at these steps and you say, well, there's clear hurdles to Main Street adoption, but nevertheless, this space continues to move, continues to evolve, continues to gain interest in it, and it isn't regulated at all. Okay, well, what are the challenges in regulating it? Well, the first clear challenge is it's not clear who even has jurisdiction here. It's not clear that the securities regulator has legal jurisdiction. They might under certain things, but perhaps certain things are better suited in the banking perimeter. And even if they do have jurisdiction, even if we can identify and say, no, everyone's comfortable in Canada that the CSA should be in charge of this. Well, how do we review this globally? Like if we're peer-to-peer interacting on a public programmable open source blockchain with an anonymous person somewhere else in the world, what courts and law apply to this infrastructure? So what courts and what law applies to an unincorporated distributed ledger system with automating self-governed software protocols operating on it, used in multiple jurisdictions where the substantive claim to jurisdiction can be based on entirely different concepts, perhaps contract, tort, joint venture, partnership law, antitrust, blockchain-specific legislation in some jurisdictions. DeFi creates a real conundrum regulatory because open programmable global public blockchains truly have no regulator in charge. There's an anonymity problem. The decentralized, non-custodial, composable nature of DeFi makes it difficult to identify a responsible party. DeFi users remain largely anonymous. There's no KYC or AML being conducted on this. Even if you have jurisdiction, it's really hard to enforce. Measures are largely going to be directed towards anonymous DeFi participants, or requiring some type of extra-jurisdictional remedy against a software developer, who you may have a hard time. And so your remedies as a regulator, in many cases, become limited to attempts to block the sites or the dApps through ISP providers or app stores. Well, even if you're successful in blocking sites, you say that you feel like the investor protection and financial system stability demands are sufficient to make you want to engage in a policy of not allowing DeFi, you can't prevent the copycatting. The widespread use of open source code allows participants to view, verify, and copy protocols to create independent, derivative, or competitive services very, very easily. Allows for infinite dynamic extensions. And then there's also the problem of redress, because these once a smart contract's executed, this is what many people say is the value proposition of using a blockchain, is it creates this indelible record that can't be changed. Well, that can be a real problem to redress disputes, the inability to potentially modify or reverse some of these actions. There's going to be a continual compounding data and informational deficit for the regulator, supervision and enforcement nightmare, open source replication, composability, and a constant technology and innovation speed gap. you can take a look at these when I send these to Mark, but there's a lot of risks in this space. There's this year alone, there's I think, because there was a recent one last week that I haven't updated on this slide, there's north of $500 million that's been lost on hacks on DeFi DeFi protocols, but yet public can interface in this. If they, you can download MetaMask and you can fund it with some Ethereum and you can link into DeFi and away you go, totally unregulated. There's clear investor protection risks here. There's some interesting financial and concentration risks that are emerging. It's becoming evident that that power and market ownership is highly concentrated in the hands of a few users, and that can cause some problems. It can create the potential for manipulation between platforms, manipulating on one area, like, for example, I identify here in November 2020 when the price of DAI might have been manipulated on the Coinbase exchange, which triggered these liquidation protocols on the MakerDAO protocol. When you have these whale holders, there's potential for manipulation in some of these protocols. There's technical risks, but we have to trust that the software is doing what it's supposedly going to do, and that's not always the case. It might be vulnerable to fragilities and hacks. It opens up a constant portal for illicit activity, given that there's no AML or KYC that's being done. There's a emerging evidence of scams, rug pulls as we call them on this, people losing money, but for fear of missing out on the potential returns, wanting to engage in the DeFi space, but finding themselves prey to some of these illicit activities. There's operational risks. There's potential for regulatory arbitrage. There's data privacy concerns, and increasingly there's some. I don't think systemic risk is an immediate concern. I think the market cap, DeFi, the crypto space is $3 trillion, but the DeFi space is a tiny section of the crypto space. Most of the crypto is on centralized platforms, and it's being held for the purposes of asset value speculation. But we need to be aware as regulators and researchers in this area, and for those who are practicing on this call, like your clients come to you and say, we want to create a DeFi application, and we're going to issue this governance token. It's going to be decentralized, and the governance token is going to trade on Uniswap. And we're going to create a lending or a synthetic minting protocol that creates digital assets which mirror the price movement of U.S. equities. Well, then you're stuck going, what am I dealing with here? Am I dealing with the issuance of a security? Is the governance token is a security issuance that either needs a prospectus or an exemption? Is this a business trigger for 31103? Do I have to register this as an investment dealer potentially? What about this synthetic asset creation? Is that a separate security that happens here? And well, your client is, one's based in Bermuda and one's based in Europe, and this thing is going to operate on Binance Smart Chain, and it's going to be accessible anywhere in the world. Well, right now, as a lawyer, you look to the regulatory guidance, and there is no regulatory guidance. That's one of the big challenges in this area. There's nowhere to look. You can look at what's been said about crypto assets. So going back to the very first slide, well, we know utility tokens issued in ICOs are probably securities, depending if they fit the Pacific Coast Coin analysis or the Hawaii risk capital framework. And we know that if you're holding custody of someone else's Bitcoin, then you're going to have to register as a dealer or marketplace. But if your client wants to create software on a public accessible blockchain and then stand off, and the software is governed by distributed governance tokens, but the software itself creates new digital assets, which maybe are derivatives or securities, it's not entirely clear how to even advise a client like that. So then what does the regulator do? And I'll finish with this and then open it up to some questions here. I think we're at a moment in time where we're starting to assess this stuff. So, and in terms of formal policy response, the World Economic Forum just a couple months ago put out a policymaker toolkit, which is really helpful. I've incorporated some of that toolkit into this slide, but we're at a stage in time where we're starting to assess policy responses on a spectrum, and it may not be mutually exclusive. And in many cases, it may involve some combinations. When we think about it from a spectrum analysis, we can think, well, on the one hand, we do nothing. Forbearance. Maybe we layer on a consumer warming into this and say, in nice words, this is the Insano Carnival, enter at your own risk. And okay, that's on the one hand spectrum. On the other hand, we look to ban it. Well, banning hasn't gone very well. I don't advocate for that because I think that it creates a residual chill to the innovation space. And I don't think that that's where we look. And I don't think there's a lot of appetite for that from our regulators even. I think that we're more in the innovation accommodation space. And you can see that by virtue of the regulatory sandbox initiative with the CSA and some of the provinces who are considering their own iteration of that within their legal jurisdiction. So we have those two on the one hand. Then what then are our other choices? We can issue public guidance, seek public input, which I think is a good idea. There might be egregious cases that maybe some enforcement action is necessary. The enforcement action in the crypto space to date has been either in capital raises, calling something a coin that was actually a security and needed a prospectus or an exemption. You've seen enforcement action in that space. You're starting to see enforcement action for centralized trading platforms in Canada. The SEC is being a little bit more aggressive on the enforcement action on DeFi. The subpoenas to the Terra network with I'm hearing rumors of other things that might come out soon. I know Chair Gensler has been pretty assertive, at least in the public space, about DeFi and some of the investor and consumer protection risks, and some of the fact that he said some of this DeFi isn't decentralized at all. It's calling something decentralized doesn't make it decentralized. It's a form of regulatory arbitrage where people are looking to extract gains or issue securities, make money without having to even go through the legacy system. So I think that that's something that is we need to be mindful of. But what about accommodating framework? Like, what if we start from the premise of, well, why does DeFi even conceptually exist? Let's start with that question. And I think a logical answer to that question is because the incumbent system, it's not efficient. There's what we call rents extracted. There's fees that are levied on consumers of financial products and services by the intermediaries. So the banks and the investment dealers and the exchanges and everyone that is involved in the ecosystem itself are extracting fees. And so computer engineers are looking at this going, you know what, maybe we could create a better system. Maybe we could create a system that is more inclusive, cheaper, faster, more efficient, and do it in a way that where we can then pass on the gains to the consumer. I think when we started that conceptual space, which I think is a good conceptual space to start at, we then have to say, okay, how do we create regulatory frameworks so that the leverage and volatility, the fraud, the illicit activity, the operational risk, the concentration risk, all that stuff that I showed you on that slide before, it doesn't impair the most vulnerable, but we create an innovation kind of tinkering mindset. We allow for this stuff to develop to find out if there really truly is utility in a lot of these things. And so then that lends itself to ideas like maybe light touch licensing, maybe a bespoke regime for DeFi. I know Andreessen Horowitz, for example, the large investment firm out of Silicon Valley, just recently proposed to the US Senate Banking Committee a bespoke regime for regulating DeFi. Maybe we look to things like sandboxes or some type of voluntary opt-ins or SROs to at least create some public confidence in the space, but like create a space where the tinkering can exist, but in ways that don't intersect into or create large systemic risk considerations. There's going to be a lot of need for assessment mechanisms in this space that, you know, the regulator is going to need to look beyond lawyers, for example. People with technical acumen will have, I think, over time, greater value to play in the regulatory ecosystem. Finding ways to incentivize the flow of information from the programmers themselves to the regulator, not having it operate in the opaque shadows, but having a dynamic where there is conversation for this. Because if there truly is financial utility or financial inclusion utility to some of this, then we need an environment of transparency to facilitate this. Continuing the use of sandboxes and exemptive relief, and maybe even clarifying easy cases and issuing public-facing guidance and seeking to harmonize where we can on extraterritorial responses. So with that, thanks for listening. I'm happy to answer questions and get into discussion on some of this stuff. If you're interested, I write quite extensively in fintech, and I've done a lot of writing in crypto and DeFi, and this piece, I have a piece that's to be published shortly in the Banking and Finance Law Review on these gaps and jurisdictional uncertainties. I also just published a piece a couple weeks ago I mentioned on algorithmic stablecoins. So if that's something that interests you, you can go to my website, ryanclements.com. And yeah, let's open it up for questions. So I don't know if we have any.